You're back with CNBC's Cash Flow and looking at the damage in Tokyo. The Nikkei 225 down 300 points and more off-session lows, but the pressure still on 13,515. The yen, meantime, is looking like this coming to mid-morning this Friday, 107.02 there. So we've got the dollar slightly firmer against the Japanese yen as it continues to steady and recover in Asian trade after coming under a fair bit of pressure in the overnight session as oil popped up past 140 a barrel. Early this morning we had a lot of data out of Japan, including numbers showing the nationwide core CPI in May rose 1.5% on year because of surging energy prices. It was more than what most analysts had been expecting, and the biggest increase in more than a decade. Derek Kowalczyk is Chief Investment Strategist at CFC Seymour Limited Hong Kong. He joins us live from our studios there. Derek, good to see you, and good morning. We had a few sets of numbers. We had the core CPI nationwide, the Tokyo metropolitan area, 1 month ahead, always a leading indicator of nationwide inflation. Industrial output as well, employment. Net, what kind of picture does it paint for the economy in Japan for you?
Overall, the picture is fairly negative, and there will be increasing talk about stagflation. Although compared to other economies, inflation in Japan is relatively low, but historically speaking, it is very high, and at the same time, growth outlook is deteriorating. So this talk will increase and will definitely weigh on the equity market, because a combination of higher inflation and lower growth is always detrimental for stocks. To me, the worst piece of data out of Japan today was the household spending numbers, which fell in month-on-month terms for the fourth consecutive month and were also down sharply year on year. If the consumer continues to perform like this, the economy will either completely stagnate or even there's a chance of a recession.
Yeah, indeed. I mean, the household spending bit, you know what, consumers as well as, of course, companies spend in Japan, the investment part, that's been watched out for to bring the economy back for some time. But what about industrial output? If you look at the numbers, it seems as though industrial output may have bottomed in the Jan to March period. Do you read it that way? And if so, it seems to me it would be a bit of a good sign.
Well, I think that today's data was pretty much a rebound from the poor indicators from the past 2 months. Given the weak domestic demand, I would say that the stronger numbers in May reflect mostly external demand. We saw the trade data a few days ago, which was much better than expected and was driven by demand from Asia. So it seems that continued expansion of emerging markets in this region is still underpinning Japanese industrial production, but I don't see it continuing as global growth overall slows and consumers are just too weak to sustain output.
All right, Darius, real quickly, well, let's just get this out of the way. Net, does all this mean that, you know, it's also going to keep the pressure on the back of Japan to keep rates where they are at, 0.5% even?
Yes, I think that they will not move rates this year, and if they hike them, it will be maybe in the middle of 2009, because Bank of Japan, despite saying that they do target inflation, they just focus on growth just as much, and if growth is waning, political pressure will definitely not allow them to hike rates.
All right, Derek, gotta go. Great to talk to you, sir. Thank you for your time. Derek Kowalczyk, Chief Investment Strategist, CFC Seymour, live from our Hong Kong studios. Next up on